I'll start with you, Afsaneh. What is it? Was this just some short-term turbulence? Was there a major rotation going out of growth and into cyclicals? Or actually, could it be something worse?
David, I think this could be the beginning of maybe some correction in the long term. I think we saw a lot come back at the end of the week, but we also think that coming into the rest of the year before the election, what we're going to see is much more volatility like we saw over the last 10 days.
Fair enough, Afsaneh, but Rick, I wonder whether the Federal Reserve Board hasn't, to some extent, put a floor under that volatility because of their incredibly accommodative monetary policy. Are they sort of protecting us all?
So I think that's right to a large extent. I mean, I think people underestimate when the Fed drops the discount rate to zero, drops the interest rate to zero, you create a dynamic that is extraordinary for, I mean, equities are long-durated assets. They are the risk asset that gets the biggest multiple when you bring the interest rate down. I think what the Fed's doing, and rightly so, is providing accommodative policy to an economy that needs it. But they're also, I don't think you can underestimate the liquidity they're putting in the system that is extraordinary. I've never seen in my career this sort of liquidity that's flooded through the system. The amount of cash that's on the sidelines is incredible. And again, some of this is when the Fed takes treasuries, agency mortgages, investment grade credit, and makes them such rich assets that you force the equity market higher. And I think the markets, while volatile this week, there were some technical conditions that were creating that. I do think the markets are generally in a pretty good spot.
So, Rick, it's nice to have free money as long as the prices don't go up. There was some talk this week about possible inflation coming back. Is there some risk of that at this point, particularly if we get a vaccine and this virus goes away?
So, David, I have a different view. We've been on your show for many years and talked about, I think people worry about inflation for years and talk about, historic trends. When you grow the monetary base, it leads to inflation. When wages accelerate, it leads to inflation. We're in a very different world, and we've talked about it for years, about how technology and pricing power becomes different, A, in a globalized world, but B, in a technology-driven world where you're seeing efficiencies being played out in an extraordinary way. I think the traditional metrics don't create that much inflation. We do think inflation is moving higher, but we think it's very different than you've seen historically. I mean, today we got a pretty good inflation report that came through. But some of that was you had a boost from used car prices, you had a boost from apparel, you had a boost from food away from home, and those are things that you'd expect to accelerate after you go through a crisis like this. So I do think inflation is moving higher, but I'm not that worried that you're going to see similar inflationary conditions that you saw in a manufacturing-driven, commodity-driven set of economies 20, 30 years ago.
Afsaneh, given where we are on the discount rate and the interest rate, which is approaching zero essentially, you can't put a lot of money into bonds and make a lot of money. Where are the opportunities to make money? Tech had been, but has that basically had its run at this point?
Well, that is what I think this uncertainty that I was talking about is going to impact most, because regardless of what the election results are, and I think a lot of people think elections could lead to, one scenario or another, I actually think that there is going to be more uncertainty about technology getting some form of regulation moving forward, regardless of the result of the election, which might start creating some sort of correction in tech stocks, looking again, not in the next week or two, but looking over the next several months. And I think the other thing that is very interesting, in fact, one of the writers for Bloomberg was talking about this very early this morning. If you look at the graphs of how much debt is getting created, it is absolutely enormous. It could, by the end of this period that Rick was talking about, end up being equivalent to World War II levels of debt, and on a relative basis, and to the economy. And so if that happens, you see US and Europe, in fact, with huge debt burdens. But if you look at the China numbers on debt, you don't see the same level of debt in China relative to their GDP as we're going to see in the US and Europe by the time we're done with this. So we can't assume that there'll be no impact on any of this. Talking about opportunities, though, I think, again, not to talk about negative things, as we have had huge problems with the fires in California. But what they're demonstrating is that climate change is very much with us. And David, in fact, basket of stocks that we look at RockCreek, which are looking at the renewable energy stocks versus traditional ones. We look at a basket. And in fact, you saw over the last few months that the renewable stocks are about up 35%, while the traditional stocks are down about the same amount. So looking at opportunities, I think that will be definitely one area, looking at how climate and cleaner energy could create jobs and could create investment opportunities as we move forward.
Rick, as somebody who puts money to work, whether it's on the fixed income side or in your asset allocation on the other, to what extent do you take into account the possible outcomes of the election? Because you could have a very different result, for example, with clean energy, depending on whether it's a President Biden or a second term of President Trump.
I mean, it is. I mean, we're moving into the season now. It's hard to invest when you think about the election. We invest in May and June and July. But as you get into September, October, now we're starting to think the reality is setting in about you could have a significant change in terms of where we go, not just obviously at the presidential level, but what fabric of the Senate looks like, et cetera. So you start to think about, where could you see some volatility? As you said, and I think, energy, some of the renewables, and it's some of the healthcare names. Also, the markets actually, in some places, tend to over-discount the change that you could potentially see. So we find like areas such as defense, some of the defense companies that are stable cash flow, where you won't see significant change in defense spending. We think the markets actually overdo it because they tend to anticipate, gosh, this is the traditional modus operandi, and then, gosh, do I want to be in defense? And I think some of the areas we're looking at managed care and parts of the healthcare market that I think the markets have overly discounted. So it's actually, you have to have learned in markets over the years that when markets start to get conservative and be careful about the anticipated change, that's the time that you actually need to start taking the risk, because that's where the real return comes from. So you just got to make sure that it's priced right and take advantage of it when it is.
So I'm starting to wrap this up. It strikes me we've had this whole discussion. Nobody's mentioned stimulus. We've been talking for months about a fiscal stimulus, fourth round. Is it just not that important anymore?
I think it's even more important because the stimulus we've had so far has obviously helped to some extent, but there's so much more unemployment to go and so many companies that will still lay off people, so much dislocation in the markets and so much dislocation with small businesses, as we read every day. So there is a huge need for stimulus. Plus, there is a need for better roads, better airports, better infrastructure in this country. So both in terms of both the need for growth and productivity, but the growth in terms of the needs of this country, both need us to do a lot more. And I think I was reading Rick's piece on looking at the need for investment and R&D, which I think, Rick, you wrote this a couple of months ago, but it is a timeless piece, I thought, and very relevant to our days today.
In my experience, Rick's almost always timeless. No question. Just to wrap up, final word, Rick, do you agree we've got to have that stimulus?
Oh my God, I thought it was perfectly well phrased. I mean, you can get deluded into believing there was a shock, the amount of the stimulus that came into the system that certainly improved income levels. Now you're seeing some rapid improvement in employment, but we should not be deluded into believing that the economy has enough momentum on its own. It needs stimulus. It needs capital investment. It needs infrastructure, state and local funding, healthcare funding. There is more that has to be done. And listen, I actually think the points around debt are definitely right. I actually think the system, if you put more people to work, you can absorb a bit more. So it has to happen.